In this section, I'm going to be covering the different types of benefits or perks you're going to encounter when working as a software developer. I put this together based off of my own experiences because I find that there are no easy answers when it comes to what types of benefits that are available or that you should expect. I've generally divided them up into what I'm calling standard and non-standard. The standard benefits are what I would consider an expectation. If you're hiring on a company as a full-time employee, you're going to expect these types of benefits, from health benefits to yearly raises. On the other side, I have what are the non-standard benefits. These are benefits that typically aren't going to be offered, so when you find them, you're either in a more senior or desirable position, or you've encountered something which is more rare. I will also note which of these benefits you will expect to be given to you up front, like health, dental, and vision, just in talking to the company, and then things you'll expect to be in an offer, like the 401k, the matching, and the bonuses and the PTO, for example, would be in the offer. And then the other stuff may not be in an offer, depending on the situation. We'll start with the big one, medical insurance. You need health insurance. The statistic I'm putting up here is that 66.5% of all bankruptcies are the result of some medical debt. So you want to make sure that you have health insurance. You are one emergency away from being bankrupt, most likely. It's worth noting that the average cost of health insurance in the United States for a family is $560. And so you can use that in terms of a monthly rate to kind of see where you're at in terms of your health insurance offerings. I've seen health insurance everywhere from actually lower than $400 a month to government type plans which are upwards of $2,000. Consider that when you're a full-time employee of a company, that company in all likelihood is paying some percentage of the actual health insurance cost. For example, the cost of your family insurance may be $2,000 a month, but the company is paying, let's say, 70% of that, so you're only paying 30% of that. And that's how we get down to the national average. Health insurance is going to be a standard. If you're a full-time employee, you should expect health insurance. There's other types of health insurance outside of just the medical though, specifically dental, going to the dentist, and vision, going to the optometrist. It's become fairly standard for companies to offer additional dental and vision plans. However, I found that they can be greatly variable, everywhere from $10 a month to upwards of $100 a month. Generally speaking, the bigger the company, the better the medical insurance is going to be. It's also become standard to have an HSA or an FSA type account. If you're not familiar with those, a health savings account is a tax-advantaged medical savings account available to taxpayers in the U.S. who are enrolled in a high-deductible health plan. That means that you're paying likely more than $6,000 a year in terms of a deductible. The funds are contributed to an account that are not subject to federal income tax. That means they're tax-free. Unlike an FSA, the HSA funds roll over and accumulate at the end of the year if they're not spent. HSAs are actually owned by the individual, which differentiates them from a company-owned HRA or health reimbursement arrangement. FSAs, or a flexible spending account or flexible spending arrangement, is one of a number of tax-advantaged financial accounts resulting in a payroll tax savings. One significant disadvantage, though, is that FSA funds do not roll over at the end of the year. That means if there's any money left in the account, it's gone at the end of the year. A 401k is an employee-sponsored defined contribution personal pension account, as defined under 401k of the U.S. Internal Revenue Code. Periodical employee contributions come directly out of their paychecks and may be matched by the employer. This is where we get into matching. I've seen matching anywhere from 2 to 6%. There are two types of 401ks. For Roth accounts, contributions and withdrawals have no impact on income tax. For traditional accounts, contributions may be deducted from taxable income and withdrawals are added to taxable incomes. There are also limits to contributions. The benefit of Roth accounts are that they're tax-free capital gains. Considering that the average IT employee only works at a company for, on average, 2 years, the 401k is something you can take with you. When you leave a company, you want to make sure to actually cash out your 401k and then transfer it into something that's likely an IRA. It's very important as a part of your software career that you actually have an investment portfolio. Generally, you're going to pay a third-party company to do this for you and will handle instructing you on how to take your 401k and move it into your IRA. The bonus is something you're generally paid on a yearly basis, which is based off a percentage of your salary. I've seen rates everywhere from 5 to 30%, where according to the internet, 10% is good, 15% is excellent. Now, this bonus is going to be both based on your own performance, but also based on company performance. For example, if your company had millions of dollars of losses, you're probably not going to get a 15% bonus. However, you will still get a bonus. It's important to note here that sometimes companies will make a global announcement saying that there are no bonuses. My experience tells me that's never true. That just means there's not great bonuses, but the really good people are still going to get some sort of bonus. The bonus is also something which is going to be covered generally in the offer letter. For example, in the offer, it's going to give you your salary and then tell you what the possible maximum bonus is. But consider you're not entitled to any of that. You could get everywhere from 0% of the bonus to 100% of whatever that number is. Now let's talk paid time off, how much vacation you get. The average in the United States seems to be around 2 weeks, but as a software worker, you're not going to adhere to the average in most cases. So a 2-week would be the absolute minimum, even as a new employee, that you would ask for. PTO is also generally based off of seniority. The more senior you are at a company, the more likely vacation you have. This can also be something that you work out inside of an offer. For example, if you have 15 years of experience and you're moving to a new company, you should not be accepting, the base junior 10 weeks of minimum vacation. You're going to negotiate, and this will be covered in your offer, how much vacation you're entitled to. You can do better than the industry average. There's also a more popular option, especially in a lot of tech companies, known as unlimited PTO or responsible PTO. The idea is that we're not keeping track of paid time off, you just take as much as you feel you need. This is somewhat of a double-edged sword. Yes, it's great that you don't have a cap on how much PTO you can take, but they're not going to let you take 3 months off at one time. There can also be some stipulations around this. For example, you have to get more than 5 days approved, or you can't ever take less than 5 days. So you want to be really clear on if there is an unlimited PTO option, what the stipulations are. Raises are something that are not going to be covered in an offer. A raise is a way to incentivize employees to remain there at the end of the year, but also reward them for past performance. There is no real guarantee that you're going to get a raise, but the average, according to the US statistics, is anywhere from 3 to 5%. Why does this matter? Because if you don't get a raise, you're essentially losing money, and this is because of inflation. Consider that the average inflation rate in the US is 2%. That essentially means that the value of the dollar is dropping by 2%. And so if you were to not get a raise at the end of the year and inflation was 2%, that means you're actually making 2% less money. This means that at a minimum, you want to have raises keep up with the inflation rate, otherwise you're literally losing money. Just like with bonuses, sometimes companies will have a rough year and will make the statement that there are no raises. I have also found that that has never been true. Some employees, especially ones that are good, they're going to want to incentivize to stay there, they're still going to get raises. They won't be big raises, but they generally will be enough to cover inflation. Now we're getting into some of the more rare benefits, and we'll start with the employee stock purchase plan. This is something which likely isn't going to be covered in your offer, but may be in fact covered up front as a part of the health benefits. This is a type of company-run program in which participating employees can purchase stock at a discounted rate. Employees contribute to a plan through payroll deductions, which build up between the offering date and the purchase date. At the purchase date, the company uses the employees' accumulated funds to purchase stock in the company on behalf of the participating employees. It should be noted that the IRS limits the total contributions to $25,000 a year, and the average deduction is anywhere from 5 to 15%. It's also worth noting that most would consider this a medium to high risk type investment because it's stock. Stock can change greatly over time. Also consider that there's going to sometimes be rules around when you can actually buy and sell this stock. as to prevent insider trading. There'll generally be windows in which these activities can occur. It's also worth noting that a stock purchase plan is only going to be available for companies which are publicly offered, meaning that they have a symbol on the stock exchange. Something you will encounter when dealing specifically with startups or privately held companies are what is known as stock options. A stock option, also known as an equity option, gives an investor the right, but not the obligation, to buy or sell stock at an agreed upon price and date. There are two types, puts and calls. Puts is a bet that a stock will fall, which is not going to be typically an option, and a call is a bet that a stock will rise. Because it has shares of a stock, as it is an underlying asset, stock options are a form of equity derivative and may be called equity options. Employee stock options are a type of equity compensation given by companies to some employees or executives that effectively amount to call options. These differ from listed equity options on stocks that trade in the market as they are restricted to a particular corporation issuing them to their owners. This is something that you can expect to generally be as a part of an offer, but it's going to be something that will likely require vesting, meaning that you're going to get some number of options only having first been there for some amount of time, measured in quarters or even years. While it's covered in an offer, sometimes stock options will be given out at various times in terms of bonuses, noting that this is something which is only going to happen for private, non-publicly traded companies. The times when the options are going to be worth the most, especially for a startup, are going to be with the initial public offering. But also consider for smaller companies or even startups, there'll be special occasions where they'll come along and say, we'll pay $1 for each one of your stock options, or $1.50. Just as covered in the startup section, your stock options can be worth $0 or $1 million. It's very likely, though, that with most companies, your stock options are only going to be worth something measured in the thousands of dollars. Reserve stock units are another form of equity-based compensation, but you're going to find that they're going to be reserved for higher-level employees, people that are very senior, and specifically people at the executive levels. They're going to be something which are both covered in an offer, but also they could be given over time as a part of yearly incentive for staying on. They're going to be vested, which means that you're going to have to work there for a certain amount of time to gain access to them. RSUs are also going to be windowed. You are not going to be able to spend them or turn them into stock or cash the stock out at any given time. So the way that this works is after they're vested, those reserve stock units become actual stock, meaning that this is something that has to be for a publicly traded company. The other big guarantee here is that they're going to have a minimum price, which means that if the company is trading at $200 a share and it drops down to $100, you technically are still valued at $200 per share. In some cases, stock will just be given directly. If it has to be vested, it could be considered more of an RSU. So generally, giving stock from a publicly traded company is something which is going to be reserved to your executives, your CIO, your CTO, your C-level employees. In terms of hiring on in a new opportunity, there's also something known as a sign-on bonus, but this greatly depends. This is essentially cash for becoming an employee, and it can range everywhere from $5,000 to $60,000, depending on how desperate a company is for your services. This is something, though, which simply can't be expected. It's either going to be offered or not, and generally you're going to be looking at the lower end of the spectrum. You can try to negotiate this, but consider that the sign-on bonus is a part of the full package value. And so when looking at the full package value of an offer, you have to consider the salary, the bonus structure, stock options, RSUs, and then the sign-on bonus. And so if you're getting into things like negotiation, you're probably going to stick with the same actual value. They may just be swapping sign-on bonus into the salary, considering though that the salary is more important in my opinion because it's guaranteed money in the next year, where a sign-on bonus is a one-time type deal. It's really a matter of discussion in terms of what you're looking for from a financial planning perspective. There is also something known as long-term incentive. This can be greatly varied and there is no real standard for this, but it'll sometimes be called the please don't quit bonus. The way this works is that you'll be given cash or equity based off a very long vesting term measured in years, likely anywhere from 1 to 4 years, more likely in the 2 to 3 year period. The way this works is that if you're a special critical employee, you'll be given a contract that says if you stay here for 3 more years, we'll give you X number of stock options, X number of stock, or just flat out a cash amount of money. This could be anything from tens of thousands of dollars to upwards of $200,000. There really is no limit or rules around how this works. It's something, though, which is more rare and only going to be given to employees that they really want to make sure that are going to stay here for a long period of time. Next, we're talking about a spot bonus. This is really just instant cash for doing a good job. For example, if you're working on a special project, did some hard things, pulled some exceptional efforts, sometimes a company, generally at the manager level, will be able to come along and give you some extra cash. This is generally going to be in the thousands of dollars. It's nice, but you really can't expect it. But it is something to look out for if you're doing something that's going above and beyond. Something which has become almost non-existent is what's known as a pension. You can thank union employees for the existence of pensions, but what they really are is a way to guarantee a certain percentage of your salary after you retire. This is one of the reasons they become non-existent, is because they're a guaranteed amount of money, as opposed to your own vesting portfolio containing your 401k, your stocks, your mutual funds, your IRA. The pension is just a guarantee of whatever your salary is. Usually your ending salary, they're going to guarantee you up to 80% of that just for sitting around and doing nothing. This, of course, requires a very huge amount of vesting, generally 20 or more years. This is something also which you will only find in older non-software companies. But I have found that almost every company on the planet has gotten rid of these pensions just because they're not as cost effective and they're hard to keep up with. I have had at least 3 pensions taken away in my career so far. Companies will come along and say, we're not doing the pension anymore, we're getting rid of it, but this is a good deal. It's not a good deal, it's never a good deal, they're lying to you. Do the math, you can figure it out. Losing the pension is always a bad deal. But there's not much you can do about it. However, I can say that a lot of these companies had the pension as something that made them stand out from other companies. So by getting rid of the pension, they're just another company.